The Financiers Association of Australia was initially established in 1927 and incorporated in 1934. The FAA is recognised as one of the industry's specialists on matters relating to finance and credit management throughout Australia. The association is an organisation for persons and companies involved in the fields of finance and credit provision. By promoting professional unity amongst its members, the association is able to represent the finance industry with the objective of educating, training, and informing its members with a view to expanding the proficiency of the industry. The first item on our agenda relates to some misconceptions regarding the 48% interest rate cap which has now been imposed on our industry in some states. Our association, in conjunction with Minute Software, together with other associations as well as many private companies and organisations, such as the National Financial Services Federation, Cash Converters, Money Plus, Cash Stop, and City Finance, to name but a few, have made numerous and comprehensive submissions to government regulators concerning the controversial topic of capping the amount of interest that finance companies can charge for their products. Essentially, all of these submissions have fallen on the deaf ears of regulators and have been rejected outright, without any formal process of impartiality or equity. This video will provide a brief overview of our perspective of the 48% interest rate cap and what seems to be the over-regulation of our industry. Meet Little Miss Sally, our representative consumer. This chap's romantic notions towards Sally are in no way indicative of the way we treat our clients. There is heart, yes, but it's all about business. The providers of credit in our industry can be divided into two defined sectors. The mainstream credit providers, usually referred to as banks, building societies, credit unions, and national finance companies. Secondly, we have credit providers on the fringe of the mainstream lenders, such as smaller type finance companies providing personal loans and smaller type business loans, usually for amounts of between $1,000 to $20,000. Although many of our members lend amounts far in excess of these amounts. These loans are usually for short periods, ranging in time between 1 month to 3 to 5 years, but generally speaking the term is usually under 12 months. Our industry is referred to by regulators as fringe credit providers, a definition which we regard as highly disparaging. The word fringe evokes images of strangeness, experimentation, and quackery. The new hit Channel 9 television series called Fringe involves scientists and FBI agents investigating fringe phenomena such as ghosts, aliens, mind control, and the likes. These are the modern-day connotations of the word fringe. Can you imagine the response of a smaller type departmental store, other than David Jones or Myer, being referred to as a fringe retailer? It's time all regulators dispensed with this terminology of calling us fringe credit providers, and began referring to us as finance companies, which indeed we are. Our business is a thriving business, with a market size estimated at approximately $800 million per annum, and we're a responsible industry with strict codes of conduct and regulation. Or should I say, over-regulation. Now let's address the issue of price control and price fixing by government of a perceived profit margin of 48% earned on each loan provided by our industry. Our view is that any form of price control ultimately harms the very consumers that regulators, in their innocence, seek to protect. As far as we're aware, the finance industry is the only sector in the Australian economy which is currently subject to price controls. It is our view that price controls exist as a consequence of our industry's cost of sales being transparent and visible for all to see. In other words, we are one of the few sectors that the buyer of our product, which is money, can easily calculate exactly how much markup we make on each loan advanced. The question that has not been asked by regulators is how much profit is being made by other sectors whose markups are not as transparent as ours, catering to the very same people who are esteemed clients of our businesses. Let's take a few examples. As you can see, a coffee shop selling a skinny soy latte mochaccino to our dear Miss Sally for what seems a mere $5 is effectively making a 400% markup on their cost of sales. A finance company providing a $1,000 loan to the same consumer for a period of 3 months inclusive of all the fees and charges under a 48% annualised all-inclusive cap will earn just $59.89, which would equate to a markup of 6% flat. Things don't improve for Miss Sally at the clothing store. Taken as she may be by the latest fashion trends, beautiful. We reveal that the $300 dress only costs the retailer A mere $50. That's a whopping markup of 600% to the business. We realise how inequitable price capping can become on a comparative basis, and the dangerous waters that price capping will ultimately lead to. Yet in New South Wales, Queensland and the ACT, our industry is required to be satisfied with a maximum 48% markup calculated on a daily reducing basis. And usually, due to the short-term nature of the loan, one is only left with about a 20% gross return. Price controls are inequitable and do not work. They must be deregulated immediately. The FAA shares the community's concerns about the social consequences of excessive interest rates being charged by some, but very few, lenders. Such abuses also reflect badly on the entire consumer credit industry. Put simply, the legislation to introduce an annualised cap of 48% will have the effect of driving responsible finance providers from the market and encourage the growth of an illegal lending industry. Our industry is no different from others, where minority players exploit loopholes and behave unethically, but killing the industry to weed out the few is not the way to legislate. As an alternative to price capping, our association would encourage government regulators to adopt other forms of consideration. The implementation of a licensing or registration fee for all credit providers, which could enable the industry to be self-funded in administration and enforcement. The establishment of an alternative dispute resolution scheme. The provision of an effective education and information base for consumers and industry participants to improve their knowledge of obligations and responsibilities. And finally, the introduction of targeted programs for recognised vulnerable and disadvantaged consumers. The Australian federal government has recently committed about $4 billion in funding to non-bank lenders in an attempt to stimulate competition against mainstream bank lenders. This policy approach is diametrically opposed to effectively wiping out our industry should the 48% cap continue for much longer. Most short-term lenders now run unprofitable businesses, the consequence of which includes unemployment and the further drying up of credit to the Australian public at large. Is this what the regulators really want to achieve? The international credit crisis is well known to all, and any attempt by government to wipe out additional credit on a whim without any accredited academic support for this price-fixing policy is nothing short of irresponsible and ideological. The evidence is overwhelming that our customers support our businesses and will not be able to access finance from banks and credit unions if our sector closes. Our association shares the view of modern-day economists that the most fundamental system to control pricing is through business competition, not interest rate ceilings or ideological-based consumer groups who by definition are only witnessing samples of a minute section of the public. The international experience against price capping is well known and documented by those who have studied this topic. In many countries, high-cost small loans have been the subject of intense regulatory scrutiny, and the outcomes have generally abandoned the model of price controls. However, it seems as if it is only in Australia that the debate on this subject is polarised, with lenders opposing it and consumer groups supporting price capping, yet then stating they support the lenders recovering their costs. The problem with interest rate caps on short-term loans is that often the price cap does not allow them to recover their costs. Our association and others in the industry cynically wonders how many consumer group advocates have real experience in understanding the complexities of running owner-managed businesses. And yet it is this ideology which has the ear of government. Even the World Bank has campaigned against interest rate caps as harming the interests of the very people consumer advocates and regulators seek to help. A free and open market has always been the best mechanism for achieving price equilibrium. After exhaustive scrutiny, the UK government and other competition analysts have rejected the introduction of price controls as likely to damage vulnerable borrowers and open the door to illegal lending. This is an outcome to be avoided. The next item on our agenda comments on whether the finance industry is regulated or over-regulated by government. It has been estimated that hundreds of millions of taxpayer dollars has already been spent by government controlling an industry that actually produces one of the lowest rates of returns to its participants. The current legislation, via the UCCC, TPA and many others, provides ample protection to law enforcement agencies to prosecute non-compliant business participants. It is time government backed off our industry, which is hugely overburdened with red tape, forms to complete, and watchdog fear status, which hinders normal and efficient business activity. In the words of United States Republican Party Vice Presidential candidate Sarah Palin, It is often government who does the most harm to business in their pursuit to unnecessarily regulate. Additionally, the powerful insight by the economist Ludwig von Mises over 60 years ago, when he pointed out that virtually every government intervention leads to unintended consequences that then lead to further interventions, which then of course leads to further unintended consequences. Let's hope the Australian government will take note of this warning. Let's now put the consumer first. Please consider poor little Miss Sally, do the maths, and let's get this thing changed. The final topic on our agenda concerns the matter of whether the federal government or state governments should control the finance sector. We are very happy with the recent announcement by government that it will control the industry on a federal basis, as opposed to the madly complicated state or territory basis of old. This is a step in the right direction. Let's keep moving.